Ladies and gentlemen, welcome back to the channel. Another crazy day here in the stock market that is really focused around not the stock market, but the bond market and the currency market. So we have a lot of big updates. It looks like the Fed is breaking the markets. They're breaking currency markets. They're breaking bond markets. And there was also a new report that came out today that is basically saying there is a lot of division within the Fed right now. About half the members of the Fed say that we should slow down the pace of rate increases. Some of them even talking about stopping rate increases, holding rates where they are, and focusing more on the balance sheet. And then you got the other half of Fed members that say, no, it's too risky to stop raising rates. Inflation could get out of control. But what the bond market is actually telling you right now is that the Fed potentially will have no choice. So we have a lot to talk about in a very short amount of time. Let's get into everything you need to know on the markets, on AMC stock, on everything else. Let's get straight into it, guys. So first things first, did not have much for economic data today, but what we did have was this report that the U.S. consumer is soldiering on despite soaring inflation and recession risk, credit card giants say. And this was obviously due to earnings. And it says U.S. consumers have demonstrated a willingness to continue to pay higher prices in the face of a sluggish economy that could be tipping into a recession, according to credit card giants American Express and Bank of America. American Express on Friday reported stronger than expected third quarter earnings and revenue while raising its full year forecast. The company said overall consumer spending jumped 21% year over year, driven by growth in goods and services as well as travel and entertainment. The demand for travel is particularly resilient as Americans make up for a postponed trips due to the pandemic. Consumers are also splurging on food and entertainment after pandemic lockdowns eased. So this is a good thing, right? Not necessarily what the Fed wants to see, but you don't really want to see the Fed tightening into recession and consumers slowing down in a big way. Then you get into, what has happened in Japan, right? After the boom in the stock market in Japan, people literally have those Japanese people, they have the highest saving rates in the world. So they don't really grow their economy. They really save a lot of money, right? And that's due to what happened with their stock market and with their economy pretty much stagnating out. And their stock market still over the course of 40 years has never hit a new all-time high since pretty much the 80s and the 90s. So there's that. That's a big thing that actually did come out today. And the U.S. budget deficit cut in half for the biggest decrease ever amid COVID spending declines. And obviously they're raising taxes, things like that. So that's not necessarily a great thing, but it's not necessarily a bad thing at the same time. A lot of the American economy is fueled through debt, as we know. So it's not one of those standout things, but it's definitely something that could be politicized to push the agenda. I do believe Biden is speaking on that later today. That could be seen as slightly bullish for the markets. But the main thing that is actually happening here today, and the main thing that has been happening over the last couple of weeks, is this parabolic crash in the bond market. And that's really what I want to talk about here in this video, that the Fed is breaking things. They're breaking the bond market. They're breaking the currency market. And I'm sure by now all of you guys know when the dollar strengthens in the way that it has in 2022 at a record high, it's never been higher. That's bad for companies like Apple, bad for Tesla. You heard that on Tesla's earnings call. When these companies based in America report earnings in dollars and they take in foreign currencies, Apple, 55% of their revenue comes from overseas foreign currencies. They convert that revenue into dollars. Well, you're going to get a lot less dollars, and that fundamentally changes the valuation of these companies. And these are some of the largest companies in the world. So that has been happening. The dollar has been strengthening, which we'll look at that chart. I'm sure you guys already know about that. But here, take a look at this. The 2-year Treasury yield falls below 4.5% as traders weigh potential slowdown in Fed rate hikes. It says the yield on the 10-year Treasury hit a fresh 14-year high on Friday, but bonds cut their losses after a report that some Federal Reserve officials are concerned about over-tightening with rate hikes. The yield on a 2-year Treasury fell more than 11 basis points to 4.491%. Short-term rates are more sensitive to Fed rate hikes. The 10-year Treasury yield, which hit 4.337% at one point during the session, was flat in midday trading at 4.229%. The 30-year Treasury yield, which is key for mortgage rates, jumped 10 basis points to 4.324%. And it says, the Wall Street Journal reported Friday morning that some Fed officials were growing uneasy with the current pace of rate increases and are starting to worry about the risk of over-tightening. Market expectations for a 75 percentage point hike in December dipped after the report. And that's the key. They're worried about the pace in which something like the bond yields are going up. And if you actually take a look at this chart, I was studying this chart a lot last night, actually, just to look at the scope of what is happening. And if you pull this out to the weekly candlestick chart, the bond market is breaking. The markets are going to force the Fed's hand into slowing down the pace of rate increases. This is exactly what happened in the UK. The US is a little bit more resilient, but we're not bulletproof to the effects of bonds falling this much and driving interest rates up so aggressively. Because after all, your mortgage rates, your auto loans, things like that revolve around the bond market. And even today, TLT, the 20-year Treasury, is down 1.5%. It's literally going straight down. This is either due to, in my opinion, a liquidity crisis in the bond market, probably seeing margin calls, probably seeing people forced to sell out of bonds. Mix that with the Fed that is dead set on raising rates, getting inflation down. It's not a good recipe for the bond market. And look at it. I mean, the chart tells its own story. There's a liquidity crisis going on in the bond market, in my personal opinion. This is fueled due to a lot of things, but mainly the Fed raising rates and the expectation for rates to stay higher for longer. So nobody really wants to own bonds right now, which you can't really blame them. But at the same time, you're yielding 4.5%. People should be buying the bonds to some degree. So long story short, the markets today, they are rallying. TLT is down. That should not be happening. This is because of this report that did come out. People are starting to believe it because when you look at it, there's no way they can't pivot soon. There's no way they can let the bond market continue to fall. So long story short, if we can actually get a bounce in TLT in the bond yields, meaning the bond yields coming down a bit, that's going to be very, very bullish. If we can also get the dollar to continue to come down, that's going to be very, very good. And as you can see, the dollar is dropping today about 0.79% after its parabolic rally. We're still at the higher end ranges. You're still at damn near an all-time high for the dollar. If you look at the dollar, it's never been this strong before. If you can really see a continued move to the downside, that will be very, very bullish for the markets. And what I will say in this regard is, and this might not mean anything to people, but the dollar can only go up so long. The bonds can only drop so long and so hard. At this point, it looks like you're closer to a Fed pivot, but the bond market bottoming out as well as the dollar topping out, and those things will mean a major market rally off of the lows that we currently sit at. But the big story of next week is going to be earnings, and really the big one, we'll talk about the other earnings throughout this weekend, but the big one is going to be Apple, and they report next Thursday. Depending on what Apple has to say, they do have higher expectations. That will be one of the driving factors of next week, and really the most important thing to watch for overall, because you don't have a lot of economic data next week besides retail sales that do come out on Thursday. So if Apple earnings are good, that's going to be a very bullish thing. If the Fed does pivot for whatever reason, however they do give us a slight pivot over the weekend or something along those lines, it wouldn't surprise me given the bond yields and what they have been doing, literally going parabolic like a damn meme stock. That would also be very, very bullish, but I'm not going to hold my hat on it. Now, as far as the Ortex data behind AMC stock, AMC, keep in mind, is up about 1.5% here today, which is doing very, very well outperforming all of the indexes. You can see that the short interest, the estimate is at 19.26%. The free flow out on loan is at 36.29%, and the shares out on loan is at a flat 187 million. Days to cover, inching ever so close to that 5. We're at 4.84 right now. Cost to borrow sitting at 19.41% and 100% share utilization. If we look at the live short interest, you can see the cost to borrow max sitting at about 23.29%, staying around that 24%, over the past couple of weeks, which is bullish in my personal opinion. Once you do get that Fed U-turn, or you do get like I said, the bonds chilling out, not dropping anymore, once you get the US dollar continuing to drop, that's going to be very, very bullish and help to squeeze out the shorts out of those positions. But guys, that's pretty much going to be it. A quick look at the S&P 500 and what's going on here today in the options market. You're looking at, let's let it load, a 86% positive order value. So people are starting to turn quite bullish on the S&P 500 and the equity markets here today. And I think it's got to do with basically what is said to you guys here in this video. The bonds, the Fed, they can't let this continue to happen. It's going to force their hands into a pivot, whether it comes on November 2nd at the next Fed meeting or it comes sooner than that. That's up for debate here, but I do think it's only inevitable that we will get a big rally from here, because the Fed is breaking things and there is a liquidity crisis that is currently going on in the marketplace. So guys, that is going to be all for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys want to get access to all of my trades in real time, link down below in the description of this video, and get yourself those free stocks with Webull, Moomoo, and Public if you guys have not gotten them already. Thank you for watching, and I will see you in the next one.